Good afternoon, Professor. How's it going?
Hey man, how you doing?
I was thinking about doing a call option on Intel. I was wondering if how I could tell if I would make money or not.
Good question. Options are really popular. So here's call options for February. How did I do that? If you go into Yahoo Finance and you search for Intel, INTC, Intel comes up. There's an option for options right there. You click on that and you said February, so about
Yeah,
3 months. So you click there, get the February, and you can go out much further than that if you want to, but 3 months is pretty normal. Maybe March would be good, but gives you some time for the stock to move. I copied and put those into Excel here. So here's the information. So we've got the contract name. That's not all that critical because when you buy options, I don't have this set up on a broker, but it's not that difficult to buy options. You have to tell them the date, what security, Intel, what security you're doing the option on, and you'll have to give them the strike price. So you need to give them the security, the date, and the strike price. Here's the strike price. So what the strike price means is this, let's look at $47. It means that sometime between now and February 20th, you can buy this stock for $47. Now you wouldn't do it today. If you bought the option today, you wouldn't exercise today because you can buy the stock for $43.76. So you wouldn't exercise today, but sometime between now and February, if the stock shoots up in price, you can make some money. So your question is how much money could I make?
exactly.
So here you see the bid and the ask. If you're not sure which is which, one is what you get when you sell something, one's when you buy something, but you know that if you buy something, you're going to pay the higher price. And when you sell something, you can get the lower price. So you just know the ask is what you're going to pay if you buy it. So you notice that if you bought Intel option today and immediately sold it, you lose 10 cents right off the bat.
Yeah,
So that's not good. That's the bid ask spread. So that's a pretty wide spread. Sometimes the width of the spread can tell you that it's not a very liquid option. You might make you a little nervous about buying. You can see there at 30 cents. That's a pretty wide spread. So it's telling you to buy this option, it would cost you $3.75. So let's look at the formula. Gain on option, you would buy the option, the premium would be $3.75. It expires February 2026. When we said the strike, we would do
47.
$47. So that's what you'd have to tell your broker and your broker to be set up. They'll walk you through it. It's pretty straightforward. One thing that's important with options is you really can't just buy one option. So you buy not an option, but you buy an option contract. A contract is 100 options. So when you did this contract, it wouldn't cost you $3.75. It would actually cost you $3.75 times 100.
$375.
Right. So you're invested 375, but it's as if you've got 100 options. So you're whatever the stock price does, it's going to give you that times 100. So if that's our option, what's your gain? And it really depends on what Intel stock price does. If you're buying a call, what do you want it to do? Go up or go down? You're going to be buying it for 47. Yeah, you want it to go up a bunch, right?
Yeah.
So here's a formula that you got to know. Really important. It's max S minus X. S is the stock price. X is the strike price. We know here our strike price is 47. So what you're not sure about is where will Intel stock price be? You have until February for its stock price to rise. You got plenty of time. Sometimes I like to look at the summary and just see where their stock has been the last few months, try to get a sense of what the stock price could do. So let's do a few scenarios. Let's say in February the stock price is
51.
51. All right, we start with 51. All right, so what is your gain? Your gain is going to be the max 51 minus 47 and 0. What's the max of 51 minus 47 versus 0? Which is higher, $4 or 0?
$4.
$4.
Yeah.
What did you originally pay for the option?
$3.75.
$3.75. So what do you
Wait,
have
are
here?
we multiplying it by 100?
We will at the very end.
Okay.
I like to do it like, and you can do it either way, but I do it at the very end. So you made $4 on the option, but it cost you $3.75. So you made 25 cents.
Yeah.
0.25 times 100. You made 25 bucks.
Oh, 25. Okay.
Yeah, so you're going to actually buy Intel for 47. You can turn right around and sell it for 51. So you make $4, but you paid 375 to set it up. So you only make 25 cents because you have 100 options in your contract. You make $25. What if the stock price it goes up, but only the 46? Then what do you have? Then your gain is the max of 46 minus 47 and 0. What's higher, -1 or 0?
0.
Right? So you have 0 minus 375. And how did you do here? You lost $3.75 minus 375
Times 100.
You just lost your entire $375.
Oh, that's not good.
You lost 100%, right?
Yeah.
Well, if the price shoots up to, well, let's look back. You know, what is its history? Let's say it gets back up to in the 60s. What if it gets up to 60?
68.
68. Yeah, you'd be really happy, right?
Wow.
Unlikely to do that in just 3 months, but who knows? It's reacting to a lot of stuff going all over the place.
Yeah.
So 68 minus 47, that's 21. That's bigger than 0. So you have 21 minus 375. So that's going to be what, 1725? And you invested 375. So you made 360%
Good money.
in 3 months.
Really good
How
money.
much do you wish you'd put into it if you'd done that? Well,
put all my money.
you wish you'd bought 10 contracts.
Yeah.
Now this is what happens if you buy 1 contract. What happens if you do 2 contracts or 3 contracts? You just multiply everything by that. You know, if you do 3 contracts, it's going to cost you 375 times 3. If you do 10 contracts, it's going to be 3,750, but you'll make 17,250 bucks. A lot of times people like to trade these options around earnings time, and because they think the stock might move a bunch and they may get a big gain. Now that's a call. What about a put?
What is a put?
So a put is the exact opposite. Remember, the call gives you the right to buy the stock at 47. You don't have to. If it's only trading for 40, you just let it expire and you lose your $375. But a put is the exact opposite. It's your right to sell it at a certain price, right? So right now it's trading for about 40, right at 44 bucks. But let's say we do a put option that gives us the right to sell it at 40 bucks. We'll get the premium here that works the exact same way, except for it's kind of, everything's kind of backwards. Here the premium, remember you're buying the options, so 272. It expires again February 2026, and the strike, make it 40. Here's your formulas. What do you notice about the difference in the put formula versus the call formula? It looks almost identical, right? What's the difference? Max of S minus X.
Oh, you're switching the S and X around.
Right. Okay. On a put, you do X minus S. So here we say in February, it says trading for $35. Your gain is going to be here. You start with this, you do the max. You start with the strike. We said 40 is our strike.
Yeah.
Minus 35 and 0. What's bigger, 5 or 0?
5.
5. So you have 5 minus 272. That's going to give you a gain of 228. And I hope my math is good. You do 2.28 times 100, you will make $228. Because you spent $272. That's for 1 contract. If you did 10 contracts, multiply everybody by 10. What if the stock price doesn't fall much? It goes to 42. Here you do the max of 40 minus 42. What's greater, -2 or 0?
0.
0. So you have 0 minus 272.
Oh, $272.
And then that times 100, you lose 100%.
That's not good.
Which is it's not that uncommon to lose 100% on these options, because it's only 3 months and it's unlikely the stock's going to fall that much. But that's how they work. All right. Good job, man.
Thank you.